Hey everyone, my name is Leah, and today Generation Wealthy is here to talk to you about insurance and basic insurance terms. Insurance is used to help protect us against the risk of unforeseen losses, both big and small. There's car insurance, renters or homeowners insurance, life insurance, earthquake insurance, the list really goes on and on. If you're looking at insurance for the first time, it can be easy to feel overwhelmed by the unusual word choices and loads of fine print. Today we're going to talk through some essential insurance terms to help you understand the insurance basics. Not surprisingly, the first term is the actual word insurance. Insurance is a written contract which is represented by a policy. In this policy, an entity or individual, the customer or policyholder, receives financial protection or reimbursement against losses from an insurance company, the insurer. The policy describes what the insurance company will cover and how much that coverage costs. How much the coverage costs is also known as the premium. You can choose to pay the total amount up front, which is sometimes cheaper, or pay it in monthly installments over the length of the policy. An obvious question might be, how does the insurance company actually make money? Say your friend totals their car and the insurance company buys them a new one. Cars are more expensive than what most people pay for insurance, so why is the insurance company still in business? It's because the insurance company prices their premiums by calculating the probability of loss and the associated cost, sometimes referred to as the risk, which is expressed in how likely it is the customer will experience a loss. The riskier a customer is perceived by the insurance company, the costlier the premium will be. Additionally, insurance companies look at the probability of loss across all of their customers. As long as they collect more in aggregate than they pay to their customers, they continue to be profitable. Another section in your policy might be your deductible. A deductible is a dollar amount the policyholder pays to the insurer before the insurer starts making payments for a covered loss. When you think of a deductible, think first you pay, then they pay. You pay 100% of the cost until your deductible amount is met, then the insurance company covers the remaining amount. So what do you call these costs? The insurance company will call these claims. An insurance claim is an official notification to the insurance company requesting payment for a covered loss. The cost of the claim is made up by a deductible and a remainder. Let's use an example. Say you accidentally backed into something and ruined the bumper of your car. You go to the auto body shop to find out how much it will cost to fix. They tell you that you'll have to replace the whole thing and it will cost $2,000. Quickly say no thanks and call up your insurance to report the damage. So now your insurance tells you that the $2,000 loss is covered, but you'll have to pay a deductible. In your policy, you see that your deductible is $500. This means that you'll pay the first $500 and your insurance company will pay the remaining $1,500. You'll never have to pay out of pocket more than your deductible for an approved loss. Some deductibles are charged once per year and others are charged per incident, so be sure to read the deductible details in your policy. You also have a choice on whether or not you want to use your insurance when you suffer a covered loss. You can choose to pay yourself or use your insurance. Some people might opt out of using their insurance for smaller losses, especially if it's their fault, because they're afraid their premiums will increase. This might happen because now that you've actually suffered a loss, you're more likely to suffer another, which means the insurance company sees you as a bigger risk that costs them more money. So just because you have insurance doesn't mean you should be careless. It will cost you more down the line. When you first get car insurance, the insurance company won't have a lot of data about your driving habits, so they'll probably charge you a higher premium until you have proven that you aren't risky. Most insurance companies will reward you for having a good driving history with minimal losses. Some people will notice that their premiums reduce over time because they're deemed less risky, and others will even receive first-time accident forgiveness. However, if you have a bad driving history, your premium will be more expensive and for a longer period of time. We'll leave you with a fun fact. Did you know that even the color of your car could affect your premium? Drivers of red cars are perceived as more risky than others. Interesting, right? So we just gave you the rundown on some high-level insurance terms that will help you brave any insurance adventure. If you found this helpful, we invite you to subscribe and stay tuned for more from Generation Wealthy.